Good afternoon, ladies and gentlemen, and welcome to the latest installment of the Option Industry Council's webinar series. My name is Mark Benzequin, and I'm a staff member here at the OIC. We're glad that you can join us to learn more about options as a flexible and powerful trading tool. In our presentation today, Beyond the Covered Call, New Income Generation Strategies for Investors, we'll take an in-depth look at the cash-secured puts and covered combos, two new ways to help you add income to your portfolio. And as always, we'll cover the material and your questions in a quick 60-minute session. Additionally, our previous webinars can be viewed on both our optionseducation.org website and our OIC YouTube channel. That being said, ladies and gentlemen, I'd like to introduce you to our presenter today, Mr. Joe Burgoyne. Joe is the director of the Option Industry Council and also heads up our investor education endeavors, such as serving as a staff instructor and presenting live option seminars throughout the country. With more than 30 years in the business, we're lucky to have Joe's experience and expertise serve as the cornerstone of our OIC educational events. And as I know that Joe has a lot of material for us today, let's get right to it. Joe?
Hey, Mark, thanks a lot. And as always, thanks to everybody for joining us and taking time out of your busy day. First, I'd like to give a shout-out to Alan Ellman for last week's presentation. As many of you may know, OIC each month has an educational topic. This month, it's income generation. Alan did a great job with the covered call strategies last week, and I'm going to kind of build upon that foundation, going a little bit beyond the covered call with the whole idea of a covered combo. So thanks to Alan, and we'll get started. Just for those of you who may be new, and generally about 35% of our attendees are first-time OIC webinar participants. You should know that the OIC and the industry put out a document called Characteristics and Risks of Standardized Options. It speaks to the benefits and risks of a listed options product. You can get a copy of that through either the OCC or your brokerage firm. And for those of you, again, who are new to OIC, we are the educational arm of the listed options industry, founded in 1992. Really, the impetus was that 23% decline on October 19th, 1987. For those of you who had the misfortune to be in the markets back then, the industry felt that we really had to get out and start to educate investors, advisors, and others on the responsible use of the listed options product. And since 1992, the OCC, the Clearing Corporation, along with the exchanges, have been funding the OIC initiative. Speaking of the exchanges, we have 5 parent companies now. A few months ago, there were 7 parent companies, but there has been some consolidation in the industry. The CBOE recently bought BATS, and the NASDAQ recently bought the first electronic exchange, the ISE. So we're down to 5 parent exchange companies. I want to start out with a quick question for you. On average, how many option contracts trade on the exchanges each day? 500,000? 2.5 million? Maybe 7 million, 16 million, or 25 million. Tell me what you think. Give you a second for that. The industry has continued to grow after some really phenomenal growth in the period from really 2000 to about 2010. Let's see how we're looking here. More than 25 million is the winner. Unfortunately, we're not quite there. The industry is doing, I guess that's answer number, what's that, 1, 2, 3, 4, about between 16 and 17 million contracts a day, to give you an idea. But thanks for those responses. I'd like to believe we're on our way to 25 million contracts a day, but we have, despite a relatively low volatility environment, and typically more volatility, more options trading. You can see this is a snapshot of the industry volume going back to the beginning of time in 1973, when the industry started in Chicago with 16 different companies listing options. By the way, you may not realize when the industry started in 73, we only had calls. There were no puts for the first 4 years. The SEC didn't approve put trading until 1977. And as I mentioned, we kind of went sideways, under 500 million contracts a year until we get into the 99-2000 period. And that's, I mentioned the ISE earlier, that was the first electronic exchange. So I think electronic access coupled with more competition. It was up to 1999 that individual companies were only listed on one exchange. In 1999, that changed, so you had 5 different exchanges listing calls and puts on all the underlying. So the combination of more competition, electronic access, you can see we had phenomenal growth in the industry for the next 10 years, to the point where, as I said, despite a far lower volatility environment in the markets, the industry's continued to do in the neighborhood of 16, 17 million contracts each day. So thanks for your response to that. We're going to talk about covered combos today. So obviously we'll have to review what they are. We'll break down the whole idea of what the covered call and the put writing, how those two come into play when we talk about the covered combo, why investors may use the covered combo, and then most importantly, as it is with covered combos or any investment, what is your risk? And, what we don't like as investors is the idea of being surprised, either, making more money than we expected, although that's a pleasant surprise, but that tragic feeling when, how could I have lost this much money? We don't want those surprises in the marketplace. So that's why, we like to get out here and talk about the different option strategies. Another question for you. Does a covered combo have more or less risk than a covered call position? You wouldn't mind answering either more or less. A covered combo versus a covered call, more or less risk? Wow. Okay. We got some educating to do. All right, and thank you for your answer. Let's get right to it. As you can see, basically almost 3/4 of you say a covered combo has less risk than a covered call position. Let's get into it. All right, and again, that 4-letter word, risk. It always has to be at the forefront of how you think about any of your investments. Let's talk about covered combos. Covered combo, starting with a long stock position. In our example, we'll go with 100 shares. We're short a call position. Okay, our underlying is going to be XYZ. As you know, that's OIC's favorite underlying, XYZ. So we've got 100 shares of long stock. We're short a call. I hope that sounds like a covered call, what Alan covered last week. But on top of that, the next part of the covered combo is a short put position. Okay, and that's why, in our preview, we talked about a little bit of covered calls, selling puts. Selling put is the third part of this equation. So you can sell those puts. They can either be cash secured. You can do them on margin. That's between you and your broker. But, immediately think, what's my risk when I'm selling a put on top of a covered call position? That's really what you want to be thinking about. So let's go for an example. We've got XYZ trading at 52. We've got a call strike. Typically, when we do these covered combinations, the call strike is at or above the current price of the stock, and the put price is below. So in our example, we got XYZ at 52. We're short the 55 calls. Okay, so if the stock's 52 and we're short that 55 call, for those of you who may be getting started, in the option space, that call is out of the money by $3, the 55 call, out of the money by $3. And then on top of that covered call position, we turn around and sell a put. Now, of course, you can sell a put at any strike you'd like. In this example, we're selling the 45 put. So that 45 put is also out of the money because, the put is gives you the, when you're short a put, you have to take on the obligation to buy the stock. That 45 strike is below the price of the stock. So that short put is out of the money and out of the money by $7. Oftentimes in the option space, there's so many darn names, and as the slide suggests, this can also be called a covered strangle. But, for me, I've always used the term covered combo. I think we can get hung up on, the different terms. I think most important, as I've said, think about the risk, okay? The risk versus the reward. What is my potential outcome? Think in terms of outcome, because as we know, options have a limited lifespan. They can be adjusted at any time, but think about what's my potential outcome, what's my potential risk. So as you can see the last bullet here, it says we collect 2 premiums. So back to that first question, what has more risk, a covered combo or a covered call? Well, the covered call, is long stock, short a call 1 for 1, where we bring in the additional premium and risk with the covered combo is the short put. So we're short 2 option premiums. Now, when we take on more risk, there's a good chance that we need more discipline, and more risk should really, bring about more discipline. We know that, we've got the risk in the covered call, and then, the downside risk in that short put. It's considerable. We just need to know what that risk is going in, and basically understand when we have covered or uncovered option positions exactly what that risk is. Just to kind of review the whole idea of rights and obligations on the call and put side. Call holders are buyers. On the call side, you get the right to buy the shares. You pay for that right, and that right you can exercise those options and get long the shares of stock. As I mentioned, we pay the premium. Obviously, if you're buying calls, you're looking for that underlying stock or index to go up, so you're bullish. Call sellers, on the other hand, or writers, take on the obligation to sell those shares at the strike price. We don't have control because we're the ones collecting the cash, collecting the premium. The buyers have control of exercise. We as sellers can be assigned. That's the obligation we take on. And, when we talk about selling calls or writing calls, we're essentially neutral to bearish on the underlying. And these equity options are American style, meaning they can be assigned at any time. Call holders, again, you're talking about buying underlying shares at the strike price at any time before expiration. Call writers have that obligation to potentially sell the shares if the stock is above the strike, and you can be assigned because they're American options at any time before expiration. And actually, let me back up just a little bit. That whole idea of assignment shouldn't be a mystery. When there's no premium, time premium, only intrinsic value in your call options, you can expect to be assigned at any time. So there should be no surprise. If you're afraid of assignment, either cover the position or roll. But, don't be surprised if there's no premium left that you got assigned. The other, time when we can get assigned most typically is when the stock's going to pay a dividend, and the dividend amount that's going to be paid by the company is greater than the time premium left in the option. So, they're really the two most, the times when we can expect to be assigned, and we really, very rarely, do we get, or should we, get assigned as a surprise, because it's really those 2 instances, when call buyers will exercise their options. So again, in exchange for the short call obligations, we take on premium. That's the motivation. So if we sell calls, can we make a lot of money? Well, we can make exactly, and no more than the premium we took in. Sell the call for $5, most we make is $5. Okay, what's our risk? The risk is substantial, with the short call, because theoretically the stock can go to infinity, so maybe that call can go to infinity. But that's where the covered call equation, that long stock hedges your short call above your short strike. Now let's talk a little bit about, just connecting the dots and understanding, where my net stock sale price is. It allows you to start to think, where's my break even? It allows you to reevaluate, is this really the price where I want to give up my stock? Or do I want to buy back the call and maybe let the stock run? Do I want to buy back the call and roll? These are the questions and part of the fun, I think, in managing option positions. And, I was fortunate enough to trade on a floor for more than 2 decades in Philadelphia, and I must say, it is a lot of fun, the options market. I've always thought of it that way, and by and large, that's because of the whole aspect of the premium levels that expand and contract, that whole idea of implied volatility. That's what makes, the options market fun to me. In terms of our net sale price, we're going to take basically the strike price plus the premium paid. So, depending on the strategies, figuring out your break even, your net sale price can be a little confusing because sometimes you add, sometimes you subtract from the strike. But the bottom line is a little bit of repetition. We're going to the OIC's website at optionseducation.org and going through the MyPath assessment program where we download educational lessons for you. It's a good way to get that repetition to having a quick understanding for, boom, my break even is here. I'm getting out of the stock at this price. That's my net sales price. In our example, where we're long 100 shares of the XYZ, we're short the 55 call for 360. Very simply, we take that 55 strike price and add the 360 premium, which, as we know, that 360 premium represents $360 because each option contract corresponds to 100 shares of the underlying. So you have to multiply that 360 by the 100 to give you the $360. So yeah, the bottom line there is break even is going to be 55 plus the 360, where the net sale price of the stock is 58.60. Remember, we were net long that stock at 52. So a little bit of a covered call example in terms of income. This is kind of how we think when we go through these things. Current date's June 5th. Underlying is XYZ, again, stock 52. Always like to take a look at the range for the year. It gives me an idea, is the stock, a high flyer? Does it move around a lot? Is it just kind of static? Does it pay any dividend? Is it a high-paying, dividend stock? All of these factors will go into, that special sauce, which is your options premium. High-flying stocks with no dividend are going to have a higher implied volatility because common sense, they move all over the place. If they move all over the place, there's a better chance that call or put will be in the money at expiration. So what does that equate to? Higher premiums. Higher premiums, and the higher the premium, chances are the higher the risk. So just something to keep in mind. But that's why I like to look at that 52-week range of the stock to give me an idea for, so I like to call it, what's the personality of the stock? Is it a high flyer or just one of these flatliners? Now, if we're talking about a covered call position, what's the risk in a covered call? It's the downside. So, if we're looking for a stock to crater or the market to head down in any meaningful way, the covered call position is not, the one that we would choose. But you can see our forecast here is relatively neutral to moderately bullish. So the covered call position makes perfect sense in a scenario like that. The objective is to generate income, and the covered call will allow us to sell the stock if it rises. So we've got June 5th. We've got a stock price at 52. We're basically neutral to moderately bullish on the underlying. We go out to August and sell the August 55 call for 360. So again, that's going to be 52. If the stock is above 55 at expiration, we'll have had a profit of $300 in the price of the stock going from 52 to 55, and then we've got an additional 360, as we said earlier. Our net sale price of the stock is going to be 58.60. If the stock is below 58.60 at expiration, we're still going to, have that net sale price at 58.60 because that's the premium we took in for selling that 55 call. So let me ask you a question here. In the previous example, of the covered call, which stock which strike or covered call position offers more downside protection. So we've got the stock at 52, and if we get into a covered call position where we sell the 50 or the 55 call, which one offers more downside protection, selling the 50 or the 55? Would you please tell me what you're thinking with that? Where do we get more downside protection, selling the 50 call or the 55 call? Okay. I would say 70% of you are correct, and 29.7%. Well, let's talk this through a little bit. Okay. So, and again, this gets back to risk. That's what I want you thinking about. We're long stock at 52. Let's go back. So we are long stock at 52. Think in terms of the value of the calls. What call has more value with the stock at 52? The 50 or the 55 call? Well, hopefully right out of the box, it's got to be the 50 call, because the 50 call represents the right to buy or sell stock at 50. So the value of that call is going to be, the $2 of intrinsic value plus time premium. If that 55 call is $5 higher, it's $3 out of the money and $5 higher than the 50 call. So that 50 call, let's say, okay, stock's 52, doesn't really, let's say we have, $1.50 of time value. So the value of the 50 call is going to be the intrinsic value of 2, the difference between 50, the 50 strike, and where the stock is at 52. We got $2, and let's say there's $1.50 worth of time premium. So that call's worth $3.50. That's the 50 call. Well, the 55 call, if there's $1.50 worth of time premium in the 50 call, the 55 call has to have far less than that because it's $3 out of the money. So maybe the 55 call, where the 50 call is trading for $3.50, maybe the 55 call is only trading for $1, maybe $1.25. So the value of those calls is what gives you the downside protection. And, 70% of you got that. And I know Alan went through those kinds of examples last week. So, that 50 call will give you more downside protection than the 55 call because it has more value. Here's another one. Does a May 50 covered call position have more risk than a short May 50 put? So what has more, does a May 50 covered call have more risk than short a May 50 put? And that's a bit of a tough question, all right? Don't think for a second that that's easy. Does a May 50 covered call position have more risk than a short May 50 put position? Yes or no? Okay, 82%. Does a May 50 covered call position have more risk? No, it does not. That's correct. It does not have more risk. The risk profile for both the May 50 call and the short May 50 put is exactly the same. Okay, so think about that. The covered call and the short put, which is what we're talking about, have exactly the same risk profile. All right? And taking this back to the covered combo, what do we have? We've got a covered call position and a short put. Now, that short put may not be the same strike, and it likely won't be the same strike as the covered call. But just keep in mind the whole idea of risk. So very good on the answer to that question. Thank you. Reviewing puts. Okay. Put buyers, we know, have the right to sell the shares. Again, if they're long the option, they're paying a premium for the right to control the destiny and the potential to exercise. If you're buying puts, obviously you're bearish. If you are a put seller, you're taking on the obligation to buy shares at the all-important strike price, whatever that strike price is. And that's, again, where a lot of the fun comes in options from my perspective. What strike? What month? What strike? To me, they're the two big questions, when we're talking about options. But, we take on the obligation to potentially buy the stock if it's below the strike that we sell. Terminology there, of course, is assigned. We don't have any control because we're on the short side, but we get paid premium for that. If we're going to be a put seller, we're going to be neutral to bullish. And again, American style, so you can be assigned at any time. We know put buyers get to sell the underlying at the strike at any time before expiration. Put writers take on the obligation to buy that underlying at the strike if assigned at or before expiration. So, being crystal clear on the rights and obligations of the call buyer, the put buyer, the call seller, the put seller, that's a key foundation that hopefully you're all clear on. But basically by taking on, just like on the short call side, we take on an obligation, we get paid cash. And then the question is, how much risk? And when we talk about a short put, we've got significant risk because the profile, as I said, is just like that covered call profile. You've got downside protection to the point of the premium you've taken in below the strike, and after that, what's your risk? Long stock. All right? So, we'll go through some examples just to be clear, but in terms of net stock purchase price, very similar to the call situation. It's just a question of, do I add or subtract? You take that short put strike and you subtract the premium where, on the short call, you're going to take that short strike and add the premium. So in our example, we sell one XYZ $50 put, sell it at $3.80. If assigned, meaning the stock is below 50 at expiration, our net price is going to be that, our net purchase price for the stock is going to be that strike, $50 minus the $3.80 gets us to $46.20 as a net stock purchase price. So if we're at expiration, we may or not be making money depending on where the stock goes out. Short put risk considerations, as I said, that put that you're short, you take on the obligation to buy that stock. And when you buy that stock, we've got no further protection, so you just need to have the capital in the account, either through margin or being cash secured, to know that if the stock gets hit hard, you're going to take on some losses. That's where the risk is. We know the put writers' risks are considerable, and just something to keep in mind. If we take an example, another one, you get stock at 52. Again, there's that same range in the stock, 480 to 58.25. If we're going to be selling puts, we don't want to be bearish, obviously. So again, neutral, moderately bullish, generate income. We think the stock, we'd like to potentially buy it at $50 or less over the next 3 months. So in this example, we turn around and sell a $50 put and sell that at $3.80. So that's just, picking the strike and the month is part of the challenge to all of this. So using that previous example, if we sold the 50 put, just like the example said, at $3.80, and the stock at expiration is $48, are we making or losing money? We sold the 50 put for $3.80. At expiration, the stock's $48. We make or lose money at expiration. Let's see. All right. Everybody's correct. All right. So well done there. Well done. The net profit would have been $180 for the stock going out at 48. So that's good. I'm glad everybody understands that. So let's roll this thing into putting these things together. Oh, here we go. We have another. We got maybe not 100%. We've got 85% of our attendees correct here, 15%. And this, I hope you like these pop-up questions. I actually like them a lot because it gets everybody to have to stop and think. And oftentimes, by being wrong is a great learning opportunity. So let me just go through that for the 15% who may not have this just right. We sold the put at 380 at prior to expiration. So again, that net purchase price, you take the $50 strike minus the 380, takes us down to a net stock purchase price at 46.20. It's the 50 minus the 380. So in essence, we're buying stock at 58.20, at 46.20. The stock closes at 48. We're up $180 at expiration on paper. Okay, so that's how it works. But thanks for your answers. So again, let's roll this covered combination. Let's tie this whole thing together. We're talking about three different pieces here: long stock, the short call, and then the short put. So typically, we're going to sell a call above the current stock price. Doesn't have to be that way, but that's typically how the covered combos are done. If you're bearish and you're selling at the money or an in-the-money call, that's your choice. But typically, we're long 100 shares of stock. We sell a call above the current price of the stock and also sell a put below the current price. And typically, this is for a relatively neutral to moderately bullish position. Clearly not bearish because, I hope by now we understand completely where the risk is, and the risk is to the downside, and it's kind of a double whammy. So in terms of call assignment, we talked about that. We know the net stock sale is going to be your short strike plus whatever premium you take in. That's going to be your net sale price on a call assignment. The combination of buying stock, selling the call will give us an upside potential price target, and then that allows us to generate income. And then, the downside gives us a point where we like XYZ, but we don't like it at the current price. We want to buy it below the market, and that's the point of selling the put. And by doing that, we have a possibility of generating income twice, once through the covered call, the other through the short put, but always being mindful of what's my downside risk. And in this case, as I said before, it can be pretty substantial because we're both that risk profile of the covered call and the short put are identical. So let's take this example a step further. We're selling that 55 call for $3.60 or $360. We also sell the 45 put. Again, that's $7 out of the money, where the 55 call is only $3 out of the money. That 45 put is $7 out of the money. And that kind of makes some sense from a risk profile because, again, downside is where the problem is with the position. So we've got a little more opportunity for that stock to go down without having to incur losses, and that's why selling that 45 put, which is $7 out of the money, instead of say the 50 put, gives us some more breathing room. Less income, but more breathing room. So if we're assigned on the call, to the upside, we know we've got to sell the stock at 55, but the net price is going to be the total premium. Okay, if we're talking about expiration, so it's not just the 58.60 price at expiration, but clearly we'd have sold that downside put at $1.95. So you take the 360 and add the $1.95, and the total premium that we took in was $5.55, or a net sale price, if we decide to take on assignment, is $60.55. So that's really the motivation for these covered combos. Selling an additional option, taking an additional premium, and then knowing You know exactly, again, where your break-evens are, how much profit potential you have, very, very important. So in terms of the net stock purchase price, if we get assigned on the put, you know, what's our risk? So we have that net stock purchase price, and then we have to include both the premium taken in for the put and the call. And so it's going to be that same, what was it, $555 premium. So the net purchase price is going to be, we had 100 shares at $52, and then on the downside, we were short the put, and that put was the 45 strike. We took in a total premium of $555. So the net purchase price for that second 100 shares of stock is $39.45, well below what at the time was a $52 stock. So if you take the two purchase prices, divide by two, our net average price on those 200 shares of stock is going to be $45.72. I think, is what the slide said. It's basically 52 and then 39 and change divided by the 200. And, we get an average stock price of $45.72. In a marketplace where the stock's 52, that can be awful attractive. All right. And, that's assuming we get assigned and the stock is below 45 at expiration. Total risk would be the $9,145 that we have to put up for those 200 shares of stock, unless that we're doing this on margin. So questions you have to ask yourself, are you comfortable selling the stock if it gets, above the strike that you've sold? Or, if your idea changes about the underlying, do you consider rolling? Are you comfortable? And really, because there's double risk in the covered combo position, are you comfortable buying more shares? You really got to be, very solid with that. But, many of us do our homework in different ways, fundamental research, technical analysis, whatever the case may be. We're able to pick points, that we want in. And, this covered combination is a way to, take profits to the upside based on the strike you sell, and then also, buy additional shares of stock at discounts to the market. So you have to be willing, obviously, to buy the shares of stock. You got to know how you're going to handle that requirement. Are you going to buy, that stock with cash, or are you going to do it on margin? They're the questions that you really have to ask yourself well in advance. Biggest risk to the covered combo? Declining stock price. Plain and simple. As we said early on, two positions here with the covered combo. Covered call, short a put. Risk profile of both, exactly the same. You've got downside protection by the amount of premium taken in both those strategies. And then what do you have? Two long stock positions. So that's your risk. Long stock, as long as you know it and you can live with it, go for it. Losses are limited, but they are certainly substantial. And that's, a risk profile. I haven't had one of these up today, but that's, I like this slide. I didn't include the slide that, I kind of talked through this whole idea of the covered call and the short put having the exact same risk profile. I'd love to put that slide up too, because a lot of people are surprised by that. But I think this risk profile gives you a darn good idea of, the downside. That can fall off a cliff, because basically you're talking about two long positions, which again is completely fine for some investors, but you just have to pick your points. And, I think that this P&L chart does that pretty well. It shows you exactly. You can see, that middle line, that little dot on the horizontal line is break even. So you've got a nice premium to the downside, a fair amount of protection to the downside before, you get into any substantial losses. Little example with the covered combo, with the primary objective typically being income. Again, $52 stock. We know that 52-week range. couple different objectives. We want to buy more stock. Stock's 52. We want to buy more on a pullback. So, boom, the covered combo makes perfect sense. Sell a put. And then, of course, we want to take some profit if the stock rises. So just a different way to look at it. Selling that August 45 put, that's $7 out of the money, 45 put for $195, and selling the 55 call, which is $3 out of the money for $360. You know, if you were more bullish, you could turn around and sell the 60 call instead of the 55 call. But again, you know, to me, that's a lot of the fun part of the whole options. Covered combos at expiration with a stock above 55. Well, we know the put's worthless, so we've taken in that premium. If it's above 55 and we decide not to roll, we're going to have to deliver the 100 shares of 55. We know our net our net sale price with just the covered call was the 58.60, but when you add that $1.95 on top of that, our break even, our net sale price is $60.55. It's that $195 and $360 total premium of $555 gets us the $60.55. So we're long that stock at 52. We sold it at $60.55. I think we were early June to August. So you know, quite a return. Net position at expiration after this, 0. Okay, because again, the put goes out worthless. The short call is offset by the 100 long shares of stock, and you know the net position is 0, and we have an opportunity to start over. XYZ below 45. That should ring a bell. Boom, below 45. Okay, we're into our area where we're getting long another 100 shares of stock. Call's worthless, so that premium's ours. But now below 55, unless we cover our short put, we're going to be net long 200 shares of stock. As we said earlier, we take the two premiums, the 360 and the 195, subtract that total premium of 555 from the 45 strike, gets us our net purchase price of the next 100 shares of stock to be $39.45. And the average price, the 52 and the $39.45 gives us just under 45 3/4 as our average price. And then, you know, our downside is the value of 200 shares at $45.75. So, you know, just over $9,100 is our downside risk. And then, you know, you can decide whether you're going to stay long the stock, whether you want to, you know, get into another covered combo, whether you want to get into a covered call position. You know, that gets into the whole idea of planning, which we're going to touch on before we wrap up. And then if the stock's between 45 and 55, the call's worthless, the put's worthless. So basically, we've taken in, you know, our premium of the 555, and we have a choice to decide what do we want to do next. We want to roll into another covered combo, maybe just sell a put, sell a call. Again, that's where we get into the whole idea of planning. So maximum gain with this situation is we buy the stock at 52, sell that 45 put for 195, sell the call 360. Maximum gain could be, you know, $855. All right, and that comes from the 555 that we took in with the option premium, but then also the gain in the underlying going from 52 to 55. So, you know, hefty return indeed. Maximum downside loss, as I've said a few times, because I like to focus on, you know, downside. What's the worst case scenario? Could be a loss if the stock, you know, suddenly went to 0, which hopefully wouldn't be the case. You know, you'd have a potential loss of over $9,100. So a couple thoughts on planning before we turn it over to Mark again and maybe take a few of your questions. What should we do if the stock is above the call strike price when expiration is near? Okay, so the stock's above the strike, above 55 as we get close to expiration. Do nothing. Wait for the put and the call to expire and be a sign. Could be. Consider buying back the call. Well, maybe buy back the call if you're more bullish, or you just want to roll out further in time or roll up to a different strike. the key is to have a plan. Now, that plan can change, but, try not to just be, lazy or try not to think through, again, what are my risks? What are the potential benefits? What should I do? What are my choices? Try to think that through and really have a plan and stick to it. But again, plans can change, but just make sure if they change, you stick to those new plans. Another question, what should we do if the stock is between the call and the put strikes as expiration nears? Well, we could buy both back to close and avoid assignment, or we could just let the options expire. There's no correct answer to the question. Have the plan and stick to it. Personally, as a trader, I used to buy back those short options because you just never know, and then potentially roll to another. I think this is our last follow-up question, what should we do if the stock is below the put strike at expiration? Roll to another put strike, a lower strike, or maybe, a strike just in the money but with more time where you wouldn't get assigned. That's a possibility, but that would suggest that you don't. Your plan has changed. You sold that out of the money put because you wanted to buy stock at this lower level. So clearly, if you're going to roll to another put, chances are your plan had changed, but rolling can roll the risk. So maybe that's how your plan did change. Maybe the market rolled over unexpectedly. So again, changing a plan is a good thing, but try to stick to the new plans once you implement them. Keep the short put, accept assignment. Boom, could be. Know full well you've then doubled your risk. Buy back the short put and realize a loss, possibly. Reassess. Again, hard to say, but especially to the downside, because the covered combo position takes on, additional downside risk. Consider having a stop loss point where, in our example, heck, we're talking about a $52 stock. We were purchasing that next 100 shares of stock below 40. Remember? We took in $5.55 from the 45 strike. We were buying that stock at $39.45. Originally, the stock was at 52, so that's a heck of a discount in the marketplace. Still, if because the risk gets, more serious to the downside, the whole idea of a stop loss, can be advisable. So I just ask you to consider that. Bottom line here, we're talking about harvesting or collecting premium. And when we talk about writing or selling options, whether it's calls or puts or both, do understand the risk, because it can be very substantial. And I think I mentioned this whole idea of early assignment. It's always possible, but we almost can always tell when we're going to be assigned. 23 years on a trading floor in Philly, I can count on one hand, and I wouldn't be using all the fingers, when I got assigned unexpectedly. All right, you can almost always tell when you're going to be assigned, and I had mentioned those couple examples earlier. So, Mark, how about if we take some of our questions? A lot of numbers on this, Mark. I hope. I hope everybody was able to keep up. A lot of numbers.
There certainly were a lot of questions, Joe, so we're going to have time to get to just a few of them. For the rest of you, if we don't answer your question directly, please feel free to make use of our investor services group at options@theocc.com, and we'll certainly get back to you. Joe, let's talk about the covered combo, and I know you touched on this briefly. How can you roll, the stock goes against you, things aren't looking so well. How can you roll your position prior to expiration?
Okay, so again, focusing on risk. We got two potential rolls because we have two positions. We got a covered call, we got a short put. Let's go to the put side first because that's where there's more risk. So, I was kind of you're right. I was just talking about this whole idea the stock was 52. Heck, the net price we're going to buy the stock is $39.45 on the second 100 shares of stock, but maybe something's changed. Now, you do have the choice of just closing out. If you really think things have gone wrong, don't spend time and money trying to turn a position you don't believe in into something good. I assure you, I've done it maybe hundreds of times, hopefully not. No, not hundreds, but I did it plenty of times, over those 23 years in Philly, and it usually doesn't work out. It drains you. It takes your positive energy and focuses it on something negative. So, taking that loss can oftentimes be the best thing. But you have to have had a significant change in your opinion. And if that's the case, close out. In terms of rolling, from the short put side, let's go back to our example. We're short the 45 put. So we could roll out in time, which would mean we would just be rolling out the 45 put from August to another month to take in that premium. But to give us more downside buffer before we start to lose money, we would clearly take in less premium. But let's say, we rolled from August to November. We do that in the 45 put, and maybe the put's worth $5. If we instead roll down and out to November, that 40 put might be worth, $2 to $2.50 if the 45 put's worth $5. So you have, two questions you ask yourself. Do I want to roll down to minimize my risk, or do I just want to roll out to buy some time? So that's the downside. And we, because that's where there's twice the risk, we want to focus on that first. To the upside, it's basically just talking about how much money. I won't say how greedy are we trying to be, but if the stock was 52, we shorted the 55 call. As I mentioned at one point, if we were more bullish, maybe we want to sell the 60 call instead of the 55 call. So where's the profit potential come in there? Well, instead of the potential for $300 of profit, with the stock going from 52 to 55 before we get assigned, you've got $8 of potential profit. Stock going from 52 to 60. And then on top of 60, in the 55 example, our net sale price was going to be $58.60 plus the put premium. Clearly, it would be higher than that if we sold the 60 call, because we'd have that additional $5 of potential profit, with the stock. Less downside protection, but more upside profit potential. So, two potential scenarios for rolling, Mark, and hopefully folks understand what I'm talking about there.
Okay, terrific. Now, Joe, here's a question that literally probably came across my screen 30 times today. How do you pick your time frame when you're putting on the strategy? Are you looking at weeklies? Are you looking at 30 days out, 60 days, 90 days? How do you pick what time frame works best?
What wasn't it called, a Ouija board, Mark? No, that's mean. That's mean. As I said, a fun part, but also, the challenging part. Again, the two key questions here: what strike, what month? That's that's the game in options, and so things to consider. You're not doing positions like this in stocks you don't know anything about. That's for darn sure. So, how do you feel about option premiums and the movement in the stock at earnings? That's number one. So 4 times a year, we have a corporate announcement. So, are you going to have this position in front of or after a corporate announcement? I'd say that's the number one thing, and that's true of any option position. How do I feel about corporate announcements and my earnings announcements? And, the great thing is you can do homework. We know when earnings comes out. At our website, optionseducation.org, you go to the implied volatility charts, and you can see, do option premiums in my favorite underlyings, do they pop in advance of earnings? How much does the stock move? I mean, that's the beauty of all this technology we have. We can do our homework, and really, even for people who know their way around, the option space, you can do that homework in an hour. For those of us who kind of just getting started, it's going to take a heck of a lot more time. But I would say many of you in the option space know that optimal period to expiration is 45 days and in. Okay, so if you're talking about taking these things to expiration, 45 days and in, you also have to ask yourself, what is my goal here? Is it just income generation? Am I looking to sell 60 days out and cover, with 15 days to go? There are lots of different approaches, but generally, where that acceleration of decay, really picks up is inside of 45 days. That's not to say you only do these strategies inside of 45 days, but that's where, because it's a decay collecting premium, that's an area that you want to focus on.
Now, Joe,
one more
yeah.
thing I'll just add. Any option premium strategy, please be aware, and I stayed away from it today because we're talking income generation, but be aware of the relative levels of that implied volatility, which, again, you can find on our vol charts at optionseducation.org. Go ahead, Mark.
Now, you just briefly talked about earnings. I know that last week, Alan, during his covered call presentation, talked about how he stays away from earnings. He will not put a covered call on a security around earnings season. What are your thoughts about that, and how does that relate to the covered combo, for example?
Well, it relates and I know that is Alan's approach to the marketplace, and more power to him. He is, very successful in his blue-collar approach, as he likes to call it. I am both involved, and I go both ways. I mean, I am incredibly flexible and always was as a trader on the floor, maybe to my detriment, but I think it helped to keep me around for 23 years. I will. The key is, from my perspective, it's the homework, okay? And, we're talking about a covered combo here. If you're nervous about earnings, maybe instead of just selling the put, you sell a put spread. And you can call that whatever the heck you want. But at least that way, you've minimized your downside risk, okay? To the upside, it's, I have no problem whatsoever doing covered calls, into earnings, because I've calculated my return on investment, and that's why I put on the covered call. If the stock takes off, well, I got to sign faster, and that's a good thing. So I am very much willing to put on these strategies around earnings. Just know the risks, and like I just said, maybe consider a put spread if you're nervous about just being short that one extra put.
Okay, terrific. Well, Joe, it's by my watch here, it's 4:31 Chicago time. So, ladies and gentlemen, thank you for your time today. I apologize that we weren't able to get to all of your questions, as there were a number of them that came across our console. So I'm definitely thankful and appreciative of all the questions that you asked. Our investor services group will definitely be standing by to answer those questions. We will actually be responding to your questions within the next day or two, as there are so many. If you have questions in the meantime, please feel free to reach out to us, options@theocc.com. And don't forget to follow us on Twitter at options_edu, and like us on Facebook. For our previous webinars, be sure to check out the video series page on our optionseducation.org website. So please make sure that you check out our website for more details. Ladies and gentlemen, and Joe, thank you again for your time. Ladies and gentlemen, thank you for attending, and we hope to see you again. Thank you.